more on the SpaceX IPO frenzy and whether investors are getting on board. A rocket to the stars or a damn squid? Equiti Group Chief Strategist Noureldeen AlHammoury will be giving us his take. Keep it here with us. This is Bloomberg.
The challenge, of course, is that the Iranians don't seem to be giving on the things the president wants them to be giving on. And so you have this tension. The president, on the one hand, wants to end the hostility because he needs to address questions around high energy prices in the U.S.
Is this the first signs of actually demand destruction from the very strong higher energy prices? So even if the conflicts in Iran kind of calms down, we don't think that we reach a conclusion to that. That means that inflation is going to be out of the way anytime soon.
Some of our guests weighing in on the fallout from the latest U.S. strikes on Iran. Our next guest believes the energy hedge remains important because markets are underpricing the risk of a longer geopolitical inflation cycle. Let's get insights from Noureldeen AlHammoury, Chief Market Strategist at Equiti Group. Noureldeen, always good to have you with us. I mean, we talk about underpricing risk. We heard earlier just from Ferdinand Fresheraki talking about how oil will be headed to $150 a barrel in July, possibly $200 by the end of the year, if the war doesn't end, and that's not been priced in yet.
I mean, have a look at since for how long now we've been hearing that the war is going to end and that we are days or hours to reaching a deal. But this hasn't happened. And at the same time, I mean, yesterday, the U.S. also announced that they're resuming strikes on Iran. And the Strait of Hormuz is still mainly closed, despite the fact that they're saying, you know, there are a lot of ships transiting. If you look behind me also on Bloomberg Terminal, you'll find out that there's still at least just maybe a maximum of 1 to 2 tankers per day maximum. So that doesn't actually, you know, help supply that much. And I think this is, if it continues for another maybe 2 or 3 weeks, prices we'll see totally different prices than the prices that we're seeing right now.
So what are you anticipating? Oil higher, yields higher, stocks lower?
Yields higher and oil higher, yes. Stocks lower, not necessarily, because everybody, I think, got maybe caught off guard with how the market basically reacted over the past couple of weeks and over the past couple of months since the beginning of the war. And this was, yes, supported by multiple data points. From one side, of course, you have a strong demand when it comes to AI, which basically is still overshadowing a lot of other key figures, such as also in the U.S. we still have inflation. The risk of stagflation is still there, and it's even much higher than before. We also, the CPI and inflation still going up. Yes, we have a strong jobs report, but also I think there are a lot that is hidden maybe beneath the surface when it comes to the job sector. It's going to maybe, or I would say, surface maybe later. At the same time, I don't think so. The Federal Reserve will have to basically move anytime soon. But from my point of view here is that market uncertainty is still the same, despite the fact that the oil is still ongoing, but earnings is still helping out. But for how long this help is going to continue, I don't think so for a long time, unless if there's something meaningful, something new that we can actually see.
So what's the hedge? How do you find protection? If you take a look at gold, which has been the traditional hedge, it's actually getting cheaper.
There's a lot of people got caught off guard how gold has moved since the beginning of the war, but I don't think so. This is something that is surprising, at least to us. We've been saying a lot, or even to our clients too, that they should not be chasing gold above 5,000. Now we reached 5,600, and then now we're back to 4,000. This is a classic, basically, I wouldn't say a pump and dump move, but at the same time, this is also is driven by a stronger U.S. dollar because of the war, not necessarily because of the strong data. In addition to that, of course, the market are pricing in now at least one rate hike from the Federal Reserve by maybe by the end of the year, and this basically has changed the entire expectations. Also, I mean, at the beginning of the year there was the debate how many rate cuts the Federal Reserve will be able to do. Now we're talking about rate hikes, right. So that shift It's like what do we call it? A regime shift from a rate cut to rate hike in a very short period of time, by the way. So this is basically changing some sort of the dynamics, at least on the short term. It doesn't mean that gold trend has changed lower, but at the same time, this is only just a correction that we've been seeing, and I think so. This is just only a short term one, maybe between 3,800 to 4,000. That would be a good time to start positioning. But also, diversification remains the main when it comes to hedging.
Noureldeen, just quickly, the SpaceX IPO, buying, not buying?
Buying, and that's also on the long term, not only on the short term.
Why is that?
I mean, people, I think, are hard maybe to understand what this company is. It's not just only one company; it's multiple companies in one business. And at the same time, SpaceX would not just be an IPO; it would be the market trying to price the infrastructure of the next decade. Because again, the next, I think, the biggest win for AI next going forward, it's going to be who has the higher or the best computing power, not who has the best model. Because without a computing power, you don't have AI even.
Noureldeen, always a pleasure. Noureldeen AlHammoury, Chief Market Strategist at Equiti Group.